Bloomberg Audio Studios. Podcasts, radio, news.
He is absolutely unique as a present president, former president, governor, vice chairman, and chairman of the Fed, and that no one in the multiple years I've been covering it synthesized Wall Street, business, and economics like Robert Kaplan. He was at the Dallas Fed with a real sense of the border political economics, the heritage of the Dallas Fed around Robert McTeer and the Georgia School, their research capabilities, and we're thrilled he could join us this morning for an extended conversation. It's been way too long, Robert. Let me cut to the chase. The definitive series, which Jerome Powell speaks of, is the Dallas Trim Mean. You are expert on that with your research staff. Does the Dallas Trim Mean for Robert Kaplan, does it indicate a vector of disinflation or a new worry back to the time of, say, Wayne Angel and a higher inflation rate?
It probably suggests inflation is a new word, sticky, meaning it's kind of going sideways and we're not making improvement. And I would guess that if prices edge up a little bit, it's going to be more supply side issues from here than demand side issues.
What I'm looking at, Robert Kaplan, is the ambiguity, the swirl, if you will, of American economics with our politics. Is the sum total of what our listeners and viewers understand on this Friday, is it towards a depressed real GDP because of policy uncertainty?
Yeah, so there are 5 big structural changes going on. That's very unusual. And I'll just tick off. We're restructuring the way we do fiscal spending, and it's going to have some jarring effect, but we're going to have less fiscal spending. If they succeed, that would tend to lower growth. We're going to do a regulatory review in every industry to try to produce more productivity growth. That actually might be helpful. There's going to be an effort to control the workforce. Obviously, no more people coming in across the border entering the workforce, and we're going to deport. That tends to lower growth unless we have an effort to revitalize legal immigration. And then we're going to try to restructure the energy ecosystem in this country to lower costs. That's probably helpful. And then the last thing is the tariffs. And the tariffs have a price effect, but I would guess these tariffs and the uncertainty with them on margin lower growth. So you got a bunch of cross currents, and I would guess the net of it all is, I would guess, growth is probably slowing a little bit right now. And the uncertainty, as well as when you cut government spending and you reduce workforce growth, or you reduce the growth of it, you limit GDP growth. The effort is, I don't know if that's that concerning, and that I think the effort of this administration is to try to create more organic, more private sector growth, less government-led growth, so quote-unquote healthier growth. But top-line growth probably is going to be somewhat weaker, I would guess.
So, Robert, given that backdrop and the 5 big structural changes that you just outlined, if I'm the Federal Reserve, do I just sit on the sidelines and kind of let it all play out? Because the market is kind of suggesting that the Fed's not going to do a lot this year.
Yeah, I think the right thing, the Fed is quietly drifting stage left, and that's okay. The center stage is structural changes, executive branch changes away from the Fed. And in a period like this, I think the wisest thing the Fed could do, yes, is be comfortable standing pat, be careful about what they say, because I think commenting too definitively on how these structural changes are going to play out, it's too early to do it. Tariffs is a good example. We don't even know what the tariffs are going to be. And so, I think the Fed will do less. I think that's fine. And I think Jay Powell's communication on that has been good recently, where he's made clear we're in no hurry, and people should be prepared. Their focus should be more on what's going on at the executive branch. And the second comment I'd make, if there's a rate I'm focused on, I'm much more focused on the 10-year Treasury rate than I am the Fed funds rate.
Interesting. So, Robert, as we sit back here and we think about the economic backdrop here, how do you view the consumer right here? I mean, we've heard about and talked about and noticed in the data this K-shaped economy. How do you think about the consumer?
There's two big groups. It's confusing because there's two big groups, probably unlike maybe anything I've seen in my career. There's one group that's 65, rough numbers, 65, 70 million workers that make 55 grand a year or less. And they are struggling to make ends meet. They've lost at least 25% purchasing power. They don't tend to own financial assets. That group is spending, but they're watching every dollar. They're going to McDonald's and they're agonizing over even McDonald's trading down. That's 65, 70 million workers and consumers.
Right.
There's another 65 to 70 million consumers, 55 and older, own their home, have a fixed rate mortgage, have financial assets. And this recent period has been pretty good. Yes, there's inflation, but their financial appreciation, their financial assets has offset it. And because their mortgage is fixed, they're really not that sensitive to higher rates. And they are spending much more aggressively on services and other products. And that's why when you see corporate earnings reports, it's confusing. Which of these two groups are you serving? If you're serving that first group, you're likely seeing a much more challenging business. If you're serving the second group, business looks better to you.
Robert Kaplan with us, of course, the vice chairman of Goldman Sachs, but far more his relationship with the Dallas Fed, all sorts of academics through the year at his Harvard. We're thrilled he's with us, and we say good morning to you on YouTube, in your home, at your office. All of Goldman Sachs tuned in on YouTube.
Oh,
I mean, that's happening right now. Robert Kaplan, I got in the new Foreign Affairs last night. It's a very strong issue, folks, in these tumultuous times. Mariana Mazzucato, who Robert Kaplan is not on the same page with, the esteemed left economist, huge economic history student, Mariana Mazzucato, with a wonderful essay on where we need to go. And Robert Kaplan, I'm sure you don't agree with all that Professor Mazzucato wrote up in the new Foreign Affairs, but the one thing she talked about, you're the most qualified person I know, is the financialization that we've seen in the last 10, 20, even 30 years, even before the great financial crisis. How do you explain the financialization of the American culture and the winners you just described and the millions of losers out there that are a reality?
Well, so I'll put it this way, and you've heard me talk about this before. Listen, I work at a firm now, and we run a business, and I've run other businesses. Human capital is the most important asset you have, and that's true for the United States. It's true for the state of Texas, and so on. And early childhood literacy, secondary education, skills training, digital divide, allowing people to be more productive. That is key to a growing middle class and building the economy. And what we're seeing a little bit in the last number of years is a divergence financially between I just mentioned those two groups, working people that don't take government money, have probably been employed, done everything right their whole career, but they don't have a lot of savings. They may not own their home. And they're reading in the newspaper about another group of people out there who are rising by bounds in terms of their financial wealth and financial assets. And it seems like capitalism isn't quite working for them. And I think education is one of the vehicles to try to address this. But one of the issues with decelerating workforce growth is education tends to be paid for at the state level and city level. If you're a growing city or state, you got the money to spend on getting affordable child care, full day versus half day pre-K, all these critical things. But if you're in a state, which is probably 40 plus states whose populations are flat to down, you may not have the money. And then philanthropy, which I'm actively involved in, can help pick up the slack. but I think we should be focusing more on our human capital and a little less on financial engineering.
And Paul, that's the common ground between Mazzucato and Kaplan. No question about that. The individual education effort.
Robert, I know in your role as vice chairman of Goldman Sachs, you speak to CEOs around the world. What is their view of, I don't know, the ability to take risk, to maybe think about M&A as a growth scenario? Where are they in terms of how they feel about their business and their ability to take risk over the next couple of years?
Okay, so on the positive side, I think the prospect of a more balanced regulatory environment, more cost-benefit analysis, more, in their words, more sensible regulation. They're okay with tough regulation, but there has to be a rationale for it. I think they're excited about that. On the other hand, they're dealing with the trade uncertainty, and if you're going to domicile more manufacturing, for example, in the United States, you really need the corridor of Mexico and Canada for integrated supply chains and logistics. And when they see threat of tariffs on, for example, Mexico, which they hope doesn't happen, which could undermine logistics and supply chains, it gives them pause and makes them want to just slow down a little bit and be more careful. And the other big thing is AI and technology. Now, we've had technology innovation for years, but if you're a CEO right now, you've got to spend on AI in your business. You're not sure which use cases will work and which won't, but you got to do it. And so I think you're going to see, though, a lot of merger activity by companies who feel that, boy, if we're going to take share in the years ahead, if we're going to grow in the years ahead, we're more likely to have to take share. And we're going to have to, size and scale and the ability to afford AI investment is more important than it's ever. And I think you're going to see a desire for many companies bigger to try to deal with that.
I got to squeeze this in, too important. There seems to be another threat, happens every 2, 3, 5 years. It's not specific to Mr. Trump, on Fed independence. How does the institution of the Fed, Mr. Kaplan, protect itself and stay independent versus the McChesney-Martin challenges decades ago?
Yeah, so the thing that's always challenging at the Fed, and this isn't new, is regulatory supervisory policy at the Fed is not politically independent and has not been politically independent. The tilt of it changes, whether it's Obama to Trump, then back to Biden, now back to Trump, and that you'll see. On setting the Fed funds rate, though, and the stance of monetary policy, I think it's critical to this country that stay politically independent. Now, the president can jawbone and pressure, and that's not new. It may be more intense right now, and the Fed will do its job and should to try to the extent they can ignore that, make decisions. The biggest threat to the Fed, I actually think sometimes, is not from outside. Then you have to be careful as a governor or a president. Don't try to say things publicly you think might go over better or worry about the pressure. Just do what you think is right. And as long as they manage themselves, I think they'll get through this in an independent way.
Out of time. Robert Kaplan, next time you're on, we're doing a complete hour on do we need the dots? Robert Kaplan of the Dallas Fed, always and forever, and now vice chairman at his Goldman Sachs.